We've just explored pricing an option on two discrete outcomes based on a coin flip. Now, let's consider a scenario with continuous price possibilities. Imagine a product X where the price is randomly drawn from a uniform distribution ranging from $0 to $100. Once again, we have an option contract with a strike price of $70. Now take some time and think about what's a fair price for this option. Similar to the previous example, let's analyze the relationship between the underlying price and the option's payout. Compared to the binary case, we now have many more possible outcomes beyond just two. This scenario more closely resembles real-world options where prices typically move continuously. With the strike price of $70, we only need to consider outcomes where the underlying price settles above $70, which means between $70 and $100. So with a chance of 70%, the price is below the strike price and the option is worthless. In the other 30% of the cases, it will be above the strike price and it makes sense to exercise the option. Since we have a uniform distribution, the conditional expected value of this range is simply its midpoint, which means $85. So if we subtract the strike price from this expected value, we see that on average we make a profit of $15. One other way of seeing this is that our payout is the triangular area under the payoff curve. And the triangular area has a base of $30 and a height of 1, so the area is also $15. Combining both cases translates to an expected value, or fair price, of 30% times $15, which equals $4.5 for the option contract. In the previous video, the option on the coin flip contract was priced at $15, whereas in this video the option price is only $4.5. This difference might seem quite significant considering that both options have the same strike price and the same underlying asset with an expected value of $50. However, the key difference here lies in the variance or standard deviation between the expected value and the settlement price of the underlying product. As discussed earlier, higher volatility generally leads to more expensive options. Options benefit from higher volatility because there's a greater chance of the option being deep in the money in a more volatile underlying asset compared to a less volatile one. Note that an option is in the money if its strike price is below the underlying price for call options and vice versa for put options. Hopefully this makes sense, since if a strike price of a call option is below the trading price of the underlying asset, you can exercise your option to buy the underlying security for less than its current price, so it's in the money. The opposite is out of the money. Generally, higher volatility increases the chance that an option will at some point be in the money throughout its life. If we look at our game, the coin flip scenario has a much higher variance. The underlying price can either be $0 or $100, with a significant difference between these two. This higher volatility translates to a higher option price as well. But note that this is not a one-to-one relation and there are distributions with high variance but lower option prices. In this example, for instance, besides having a higher volatility, in the uniform distribution case, there also was a lower chance that the underlying asset will settle above the strike price. Nonetheless, you can use this relationship between volatility and options prices as a heuristic. And for famous models such as Black-Scholes, which assume a Gaussian distribution, it also holds in the general case.